Hey everybody, welcome to Mortgage Today for Friday, July 21st, 2023. And oh, what a day it was. MBS were up 14 basis points bright and early this morning. Stocks were up 12. It's a summertime Friday in the bond market, so anything can happen. There isn't a lot of liquidity, so even some small trades can move the market. We don't go into the day with any kind of elevated expectations of one outcome or the other. A survey of fund managers from Bank of America shows them to be bearish overall, with 60% expecting weaker global growth going forward. About half think a global recession will hit in Q1 of 2024. They also see the first Fed rate cut sometime in Q2 of 2024. Note the change in perception between June and July. Looking back at changes in the U.S. employment data since 1953, a period including 10 recessions, on average, the unemployment rate has not noticeably changed during the 12 months leading up to a recession. Once the recession begins, however, the unemployment rate slowly rises and peaks 12 months later at a level 3 percentage points higher than when the recession began. The unemployment rate is not a leading economic indicator for a recession. Now that the riveting headline has your attention, we may be dismayed to learn that it was pretty much a boring day. Bonds started out fairly flat and pretty much stayed that way. 10-year yields drifted inconsequently higher, whereas MBS might be a bit better, depending on where you're looking at. Attention has clearly turned towards next week's Fed rate hike and press conference. Everybody's going to be looking at the comments afterwards for tea leaves of what's going to happen in the future. MBS closed up 8 basis points on this day. Stocks were pretty much flat. We closed the week out at 99.53, which is just below this red 25-day moving average. So we have a floor at the S1 retracement at 99.234. In other news, earlier this week, we saw a Garrett Macaulay report comment on the cost to originate loans. This isn't a fun thing to highlight, but everyone talks about it. It's important to know. Below is the data for the past 5 years, and they mentioned that it is likely a numerator-denominator issue, but we also suspect that it's more than just volume. Sure, there will be some exceptions, but the economies of scale certainly aren't helping the lenders have to spend to capture the purchase business. So as you can see, over the last 5 years, the cost to originate a loan has doubled. This is, partially to do with there are less files, so you're dividing by a smaller number in terms of total cost, because certain positions, it's just a salaried position, and it's divided by a less number of loans. But still, everything indicates that the cost to originate has gone up quite a bit, largely due to LO comp. Looking into next week, we have some stuff coming. So we're going to have some PMI stuff on Monday, which will have people trading in advance of the Fed. We get Case-Shiller and FHFA home price. It shouldn't really move the bond market, but it gives us an idea of how things are looking in terms of inventory. So get a 5-year note auction. On Wednesday is the big day. We get the Fed decision and the Fed press conference. Everybody's going to be looking at that and trying to decipher that, and then reacting to that when jobless claims come out on Thursday, as well as the GDP advance for the Q2. So get a 7-year note auction. Those can move the market, and then PCE on Friday. So the second half of next week is going to be very volatile. So definitely check out some of the stuff from our sponsors at wellthatmakesense.com, as well as our sources and influences. But definitely wellthatmakesense.com has a bunch of information, including that podcast series from Chris Williamson and Alex Hormozy that has some awesome points, because the thing is, you can't control the bond market, but you can control your brain. Have a great weekend.